We have different categories of classifying audit. The first category is in terms of the scope classification of audit. So you can classify classification, and then we have type of audit. So you can classify audit types in different categories. The first one is scope. Scope. So under scope, we are looking at how wide you are going to do the investigation, how deep or intensive you're going to perform the assignment. So you can be doing specific audit where you're told to do cash audit, you do procurement audit, you do maybe tax audit, you do interim audit. Those ones have very specific areas. So we call them specific audits. Specific audit, so that is a type of audit. So under specific audit, we have different types. We can have cash, you can write. Under specific, we have cash audit. You can do cost audit. You can do as a standard audit. You're trying to look at how companies are following standards. You can do management audit. You're trying to look at the performance of management. So examiner can ask you, can you explain the following types of term or the types of audit as used in Audit Assurance? Then they ask you tax audit. What do you understand by tax audit, right? So the good thing with this kind of audits, with the name itself, you can be able to relate, you can be able to know. For example, if you're told to define cash audit, you are trying to confirm or verify the cash that is available, right? So you're checking on the accuracy and the validity of those cash that are available, whether they're actually there and whether they are on the right, at the right amount as reported. So you're verifying the existence of the cash, the validity, and the accuracy of recording those cash. You can be doing cost audit, where you're trying to audit the cost that has been used in a certain cost center. Maybe you're looking at the cost of procurement, the cost of buying something, the cost of a project. So in that case, you're trying to verify the validity, again, the accuracy of those particular transactions. You know, when we talk about validity, we are trying to check whether it is valid, whether it is true, whether it is real. So you might find that somebody has actually indicated in the books that it cost us this much, when actually it is even less amount, or there was no transaction that happened, but they are reporting like they incurred some cost. So you need to be able to perform an audit to check on the cost. When you talk about tax audit, you're trying to look at the compliance. You're trying to do tax assessment to check whether the company is complying with the laws or provisions that relate to tax, right? So we have different acts, we have different provisions, or that needs to be followed when you're doing a filing and reporting as far as the tax is concerned. So you're basically trying to check on compliance, and you're also trying to check the computation, whether the computation has been done well, whether all of them have been filed, the company is complying, the regulations, such kind of things. Then now we have interim audit. Interim audit is the audit that is done before the end of the period, before the end of the term. Normally, we have final audit, which is done at the end of each financial year, right? So final audit is done at the end of the year. So for 2023, for example, 2023, we shall do final audit in January, right? In January. So by that time, the year shall have ended. So because it is running from 1st to 31st of December, 1st of January to 31st of December. So when you're going to do it, you do it the following year, January. You now do a complete audit for the whole year, 2023, but you're doing it now in January 2024. That is the audit that is required by law. It is required by law. So it is a statutory requirement that all companies, all public traded companies or limited companies needs to be audited. And of course, we also have other companies that are required by law that must be audited. These are companies that deals with people. We have welfares, they need to be checked because they have members' money. We also have things like, we have SACCOs, we have banks, we have insurance. Any company that deals with people's money, where people have got shares, whether it was through normal membership or through buying shares, like that kind of scenario, they need to be audited. because otherwise, if they are left unchecked, then people might lose money. We have seen cases in Kenya where people lose money through such kind of schemes. Now, we also have another one called management audit. Management audit, from the word management, you know that you are now focusing on management. And when you're auditing management, what are you basically checking when you're auditing management? And of course, management includes the employees, especially at the top level of an organization. So when you're auditing them, you are basically looking at how effective and efficient they are running the organization. So you're trying to perform audit to ascertain the effectiveness and efficiency of the operations of the management, how they are operating, how they are running the organization. We have situations where management can be misusing companies' money, so they are not efficient. They're using the money, right? They are misusing the money. We have situations where management are not misusing the money, but they are just reluctant. Nothing is going on, so they are not effective. So you're trying to check on two things. You're trying to look at how effectively they are performing and how efficiently they are performing. Then we have operational audit. That is also special audit, because you're not doing general audit. You are only specifically looking at the operations. And so here also, you need to check on the efficiency and effectiveness on how the operations are being done, how the company is being run. We have other audits like procedural audit. You can be told to define procedural audit. As the name suggests, you are basically checking whether the company is following the procedures that are being given. So we normally have procedure manuals in the organization. This procedure manuals gives guidelines on how the company should be operated. It shows how the processes and procedures should be run, right, in the organization. So you need to check whether whatever is being done, the actual act on the ground, what they are doing is actually what is highlighted or provided for by the procedure manual. So in procedure, you're basically checking whether the company is compliant with the procedures. They are following procedures in their operation. So such kind of questions are very simple. The word itself or the name itself will suggest to you. And so the best thing that you can do, just use the same term. Say that you're going to audit the operations of the management. You're going to audit the effectiveness of the management. You're going to check the compliance with the procedures, such kind of things. The second type under this, under the scope, is now called general. It is not limiting us to specific area or period. It is general. It is normally done at the end of the financial year. And this is the one that is done by statutory auditors, the external auditors, where they do general audit. They check on the HR, they check on the cash availables, they check on the procedures, they check on the governance, they check on the policies, they check on tax compliance issues, they check everything. So that is general audit. It's normally done by either internal auditor. Internal auditor can do all that, and also independent auditors can also do that. So that is the first category. The second category is now called activities. You can classify audits in terms of activities. So in terms of activities, depend on the main aim. What are you doing? Are you doing commercial? Yes, it could be for business. Like most private audit firms, they are for commercial purposes. They are making money. They are doing audit to make money. And then we have non-commercials, like the ones that are done by the government, national government, or county government, or any government institution. Like we normally have Auditor General. When Auditor General is doing audit at the county government, or they are doing at the national government institutions, then they're not being paid for doing the audit. They are doing it because it's part of their role. So it is not commercial. So we have either the audit can be done for commercial purposes or non-commercial purposes. Then we have another classification. So if you are asked the kind of audit that is commercial in nature, you can explain these are the audits that are done to generate revenue. Like most of the audit firms outside here do that. We have organization that is doing audit, organization that is performing audit. So this one is basically the aim, but this one is now the organization. So organization that is doing audit. The first one is government. You can either do audit as government or private company. Government or private firms. Government or private firms. Then legal. legal requirements. We have audits that are done, which is compulsory, statutory audit. And also we have non-statutory audit. When we talk about statutory audit, these are audits that are expected by law. They are required by law to be done. So they are called statutory audit. And these ones, I say that they are done to companies like insurance companies, the state corporations, the banking institutions, cooperative societies, welfares, trust, those kind of companies, public traded companies. Those ones have got people's interest, so it is required by law. We also have non-statutory audit. Non-statutory audits are audits that are not compulsory. You do it because you are willing, you just feel like you should do it for your own sake. For example, if I have a company like partnership, you're just running your own partnership business, or you have a sole proprietorship, or you have private limited company, that one that you own yourself, do not have anybody's interest, it is not mandatory for you to do the audit. However, you can be told to do the audit if you need some services. For example, if you want to get a contract, they can tell you to provide audited account. If you want loans, you can be told to provide audited account. That is not by law. It is now the service provider that is requesting for the audit. So those ones are not statutory. They are not required by law. So they include the individual businesses. We have firms, we have sole traders, we have private limited companies. All right. Now, the examiner can ask you that as an auditor, how do you convince Mr. Joseph Kamau to perform audit when he's running a sole proprietorship and he knows that by law, sole proprietorship is not mandatory to be audited? How do you convince him? They are trying to tell you, can you tell us the benefits of non-statutory audit or benefits of doing audit, which is not mandatory? It is not required by law, but you still feel it is a good thing to be done. So what are some of the benefits that you can actually put on the audit that is being done on private companies, on sole proprietorship, on firms that are not mandated by law? One of the benefits of non-statutory audit, or we call it voluntary audit, because you are volunteering to do it. Volunteering to do it. One of the benefits of doing such kind of audit include, you can say, to be able to assess on the weaknesses, to be able to understand or determine the weaknesses that could exist in the company, so that you can be able to put corrective measures. At the owner of the company, even though it is not required by law, but it is also good for you to be able to know where are you going wrong. So to know the weaknesses or to assess the weaknesses, that is one benefit. Number two, such audits can also be used. Such audits can also be used to acquire loans or even get contracts. It can be used by banks to get loan. That is another good thing with audit. You can also explain, number three, that this audit can be used by partnership to be able to do their profit sharing ratios or to allocate the profits and losses. If you have done an audit, you'll be able to know that really the company is making profit, and this is now what we have. We can now share it according to profit sharing ratio. As a partnership, even though it is not required by law, how will you know your profit? How will you verify the truthfulness or the accuracy or validity of the figures that you are getting from the accountant? Right? So you need to be able to perform the audit. So it helps to share profits and losses among partners. That is another point. You can also say that such audits can also help to reduce conflicts between the management or the partners. Whenever somebody is claiming that maybe you are stealing too much, maybe you are taking this, for us to lay out such kind of grievances, for us to get away from such of claims, we need an independent person to come and perform audit and tell us the reality. So such kind of misunderstanding, such kind of conflicts that will incur will actually be removed. They will be part of the past, right? So it helps reduce conflicts whenever there are grievances or claims that there's loss of money or misunderstanding between the partners. That can also be done to help, right? Another thing, it is a requirement that every company must pay tax, whether it is a limited company, whether it is private or sole. How will you determine the amount of tax to be paid? It is through audit. It is not mandatory to be audited, but it is mandatory to pay tax. So for us to know the amount of tax that you are paying, then you need to be able to audit. So that is for tax purposes, you need to audit to determine the amount of tax to be paid. That is another point. If the examiner asks you about non-statutory audit or audit of statutory or sole proprietorship, the benefits, the advantages, or why you should do it, those are part of the answers that you can give, right? Then we can also say that audit also help us to know or to make the decision on whether to expand or whether to reduce our operations or whether to move from the industry. Let's take example. You have started a business, and you're not very sure of what the future holds, or you don't know whether you're making profits or you're making losses. You don't know whether the company is running towards the right direction. You need an audit so that it can help you to understand your books so that you can be able to make a decision as far as the future of the company is concerned. So you'll be able to know, should I expand? Should I put more resources? Should I remove resources and actually diversify or divert funds or divest, so that instead of investing here, I'm going to divest and now put resources somewhere else? That is something that you can only do if you are performing audit. So there are so many benefits that you can come from normal audit, even if it is not a mandatory requirement. I'm highlighting this because I know examiners normally ask such kind of questions, and so it is very important that you understand how you can be able to answer that. Let's look at the next classification. You can also classify audits. You'll proceed from where we left. You can also classify audit in terms of the examination boards or methods, examination methods. You can classify audits in terms of examination methods. You can classify audits in terms of examination methods. Classification, examination methods. You proceed from where we left. Examination methods. So what are the periods? So you can be able to examine continuously or periodically. When you talk about continuous audit, examiner will ask you, what are the benefits of having continuous audit or disadvantages? Do we know continuous audit? This is the one that is normally done in companies which have got a large stock, or they have a lot of stock that keeps on moving. So what happens is that the companies, like the ones that deal with warehouse, or they are dealing with the hardwares, they normally have a lot of goods that are leaving frequently. So for us to keep track of what is happening, to keep check so that we know that nothing goes wrong, we need to have somebody who keeps on doing audits every time. You perform the transactions, they keep on reconciling and checking on whether the transactions really happened and they are okay. So it is something that you do continuously. From the word continuous audit, it is an audit that is done continuously with the operations, hand in hand. The operation goes on and the audit also continues. Now, what are some of the benefits of having a continuous audit? When you keep on reviewing the books every day, checking the figures, checking the transactions, the benefit is that you'll be able to detect errors early. You'll be able to know that there is a mistake immediately when it happens, and then you arrest it and put the right preventive mechanisms. So it helps to detect errors early, right? So that is number one. It also helps somebody to learn. It helps somebody to learn, because if you are a new employee and you don't have work to do, you'll not be able to perform well. Or maybe you do work occasionally. But if you're doing audit continuously, you'll be able to learn, right? It also helps to give an immediate report for decision making. If I'm doing audit every time, I'll be able to give report anytime when it is required, and management can actually make a decision out of that report. So it gives immediate report for decision making. Also, it helps to detect and prevent errors and fraud. When people know that Mr. Dennis will come and check, Mr. Dennis will always come and check, even if it is today or tomorrow or in the evening, they will know and they will fear. So nobody will be attempted to steal, because they know that somebody will come immediately and arrest them. So therefore, we are saying it prevents, apart from detecting, it will prevent them from even trying or attempting to steal. It will prevent people from making errors or fraud. So we have seen such advantages. But what are some of the disadvantages of doing this kind of audit? Of course, sorry, I was almost forgetting that another advantage is that it makes the final audit easier. If you're doing continuous audits, by the time you are arriving at the end of the year, whether you are the one who is going to do the final audit or someone else will come and do it, it makes your work easier. It makes your work easier because most of the things have been verified throughout the year. So it makes the final audit become easier. Doesn't matter who will do it. On top of that, it also helps to reduce risk. On the side of the auditor, if I'm the external auditor, I'm coming to audit a company that was having continuous audit throughout the year, but now I'm being called at the end of the year to come and audit the same company. My risk level is very low, especially if the person who was doing audit was competent enough to detect and prevent those errors. So the audit risk is also reduced. Now, when I talk about audit risk, what am I saying? Audit risk. Audit risk is the risk on the auditor side. We are saying it is the risk that the auditor can give a wrong conclusion. The possibility that the auditor can come and overlook or forget to see something or miss out on something. That risk that you can give a wrong report is going to be reduced. That is what we call audit risk. So audit risk is the risk that the auditor might give a wrong conclusion. An examiner can ask you what is audit risk, and then they ask you the elements or types of audit risk. Now, when you talk about audit risk, I say that we have is the risk that the auditor can give a wrong conclusion when the financial statement is materially misstated. Can you say that? Can you say that? That audit risk is the risk that the auditor can give or may give a wrong conclusion when financial statements are materially misstated. Andika hiyo kisungu. It is the risk that the auditor can give a wrong conclusion or misleading information. The auditor can give a wrong conclusion when the financial statements are materially misstated. That is what audit risk is. The risk that the auditor can give a wrong conclusion when financial statement is materially misstated. Yani, the financial statement is misstated. Instead of saying that we have cash and cash equivalent of 5M, you are going to give 10M, and then you end up signing the report. The audit is taking a lot of risk by giving the wrong conclusion when we know that there's 5 million misstatement. There's a material misstatement. So that is the audit risk. The risk that you can give a wrong conclusion. And this happens if you're not able to detect those errors. If the audit procedures that you apply was not able to help you know that there was a misstatement, that is now what we call audit risk. And I can tell you, auditors can be sued and even jailed because of such. Now, we have types of audit risk that we shall also look at in this particular topic, but let me just highlight for you the types of audit risk or elements of audit risk. Types of audit risk. Types of audit risk. We also call them elements. So components. The examiner can use any term. Components, elements. So we have the first one is called detection risk. We also have control risk. And then we have something called inherent risk. So those three are the types of or elements or components of audit risk. I can assure you that the examiner must bring something about this in exam. So it is better you understand it better. Understand it well. Audit risk is the risk that you can give a wrong conclusion. Now, when you talk about the types, these are the components. These are what makes audit risk. These are what causes audit risk. Like, for example, detection is the risk that is caused by the auditor. He has failed to apply the right audit procedures to detect errors. When you are using a wrong audit procedure, you will now not be able to detect errors and fraud. Therefore, that is called detection risk. It is an audit risk caused by detection. So you can say that detection risk is the risk that is caused by failure. It is caused by the failure of the auditor to apply the right audit procedures. It is caused by the failure of the auditor to apply the right audit procedures. It is caused by the failure of the auditor to apply the right audit procedures to detect errors and fraud, or to detect material misstatement. You know, material misstatement are basically the errors or fraud. We have control risk. Control risk is now on the side of the management. Detection risk is caused by the auditor, failure on the auditor's side to apply the right audit procedure. So he ended up giving a wrong conclusion. He ended up giving a report that has mistake because he didn't see, he didn't identify, he didn't notice. But control raise is caused by what? The failure on the management side to put strong internal control. You know, internal control is being put by the management, not the auditor. As an auditor, I am an outsider. I can't know. I can't even have the ability, but I can only advise on controls that can be put, but I can't implement them. Now, it is the role of the management to put strong internal control systems in the organization. And of course, the controls are there to prevent errors from taking place, to prevent fraud from taking place. Now, when the management have failed to put on the controls, or they put on control which are not effective, then that means that there are possibilities of errors infiltrating into the financial statement or the information. Now, such kind of errors are being caused by the weaknesses on internal control. Therefore, you can say that control risk is the risk caused by the failure. It is caused by the failure or weaknesses. It is caused by the weaknesses in the internal control systems of the company. It is caused by the weaknesses in the internal control systems of the company. That is the type of audit risk. The last type of audit risk that I want to mention, because it is very important, is called inherent. Now, these are risks that are beyond you. It's beyond you as the auditor, and it's beyond the management. So you cannot say that I'm blaming the auditor for not having a good audit procedures or applying the right procedures. You cannot claim that the management didn't put control. They are the exposure that the company is exposed to due to the nature of their business. Therefore, they can actually be exposed to it whether there is a strong control or not. You can actually fail to detect even if you put the right audit procedures. They are called inherent risks. They are risks that beyond internal control systems, and we cannot be able to blame the auditor. So we are saying it is the susceptibility or the exposure of the company's operation or the financial statements due to factors that are beyond the control. It is the susceptibility on the financial statement or information due to the nature of business, and other factors. The word inherent means that it is beyond certain control. So what can actually make you be exposed to this? I want you to take an example where you have a strong control in the organization. You have a strong control in the organization. And then the auditor comes during the week on Monday to Friday. He's auditing the account. After audit, he comes out with a conclusion that the financial statements are okay, the books are okay, and they represent the true and fair view. They also come up with a conclusion that according to their understanding, the company can proceed in operation for the next 1 year. They are very sure that according to what they have seen, the company can still proceed in operation for the next 1 year. Now, that is an audit that is done within a week and the report is given. Now, on Saturday, over the same week, the CEO has decided to misbehave outside the company. The CEO has gone to drink or some pub, they misbehaved. What happens? When the CEO misbehaved, the following day, everything will be in the social media. Now, when we have the information, breaking news on social media, what will happen? The customers will start running away. The donors will run away, right? The suppliers will run away. I'm assuring you that most likely by Monday, the company can go down. The company can go down because of something that happened overnight. Now, in such a case, do we say that auditor was lying? Because he promised us that the company can proceed in operation for the next 1 year. But then now, it only took 2 days and the company is down. Yes, the auditor was wrong. But that kind of error was not caused by the audit procedures. It was not caused by the weaknesses in internal control. It was caused by factors that are beyond the company's business or control system. Another example, if the company is running in an industry that is not predictable, the industry that keeps on changing. Let's talk about a company that is growing with technology. A company that is just has a lot of technology that is coming in, and even the management do not understand there are new things that are coming in. For a good example, if you are running in a company where The laws and policies keeps on changing. Today unasikia government wameongeza hii, kesho wameongeza hii, they keep on changing, like the tax laws that we are having in Kenya. They keep on changing every day. So you end up having wrong information, not because you have not done the right work, but because of the nature of business. You are in an industry which keeps on changing, shifting from one to another. So that factor is beyond you. You can give a report now, in the evening things change. You're being told the business is no longer viable, or you're not allowed to operate that kind of business. Whom do we blame? We don't blame the internal control. We don't blame the auditor for not putting the right audit procedures. But we are saying that is something that was beyond the auditor and was beyond internal controls. Therefore, it is called inherent. The last type of audit that I want to mention is we're looking at who conducts the audit. Who conducts the audit? Who conducts the audit? And here we are talking about the either internal auditor or independent auditor. This is external, independent, stroke external auditor. Of course, independent internal auditor is an employee. Most of the cases they are employees of the company, or they can be outsourced. Independent auditors are not part of the management. They are not part of the employees. They are not part of the employees. So, okay, I'm not sure if you guys have any questions so far. Do we have any questions so far? Are we learning something new? Should we continue with lunch hour class? I need comments from you guys.
Yes, we can continue up to 2.
So you are suggesting that we should continue with lunch hour classes daily?
Yes.
Okay. So we can now proceed and look at other areas. I hope that you guys are taking notes. These are areas that we might not revisit because of time. So what are the benefits of doing individual audit? And I say that these are also the same as individual or voluntary audit. Benefits of individual, so voluntary, stock non-statutory audit. Mbona tujifanyie audit? Kwa nini tujifanyie audit? I know that I'm running the company. I'm the one who is there full time. I can't steal from myself. And then I want to do audit. So the benefits, number one, is to know the correct income from all the sources, so that you can know this is the total income that I have for decision making. To know the correct income from all the sources. That is one. To prevent and detect errors or misappropriation of funds. You know, you can be having employees working for you, and so these employees can also be cheeky. They can be wakora. So to prevent and detect errors can also be there. To help in tax assessment. Of course, you'll be able to know whether you're paying taxes correctly. To help in tax assessment. To help in tax computation. To help in tax computation. Assessment is basically to check whether you're doing the right thing, but computation is now calculating. To help in tax computation. To provide assurance on the accuracy of the figures or financial statement. Provide assurance on the accuracy of the financial statements. Provide assurance on the accuracy of financial statements. Provide assurance on the accuracy of financial statements. provide assurance on the accuracy of the financial statements, to keep moral check on accountants and agents or employees, to keep moral check on employees, to keep moral check on employees, to keep moral checks on employees. Those are benefits. Let's look at government audit. When you hear government audit, what comes to your mind? These are audits done by the government. Mostly, they're done by the state corporations. They're done on the state corporations, Auditor General or Controller or Budget. Controller or Auditor General can also perform audit. They have the right to check. So, why is it good to do audit for the government institutions? So, the importance features of the government audit. So, what happens with government audit? To check on the sanctions. Sanctions are approval. To check on the sanctions before payment of expenditures. Before payment of expenditures, you need to check on sanctions. Right? They are also done before making payment. Before making payment on bills by the Treasury. Before the Treasury makes payment on bills or for bills, payments for bills, they need to perform that audit. Also, they need to check whether the correct bills are being paid. You know, like now we are saying that there are a lot of pending bills in government, right? So the feature of this audit is that it needs to be done or just to verify before bills are paid. Another feature of this audit is that it's normally done because the company has got quite a large number of transactions. Huge amount, it involves large amount, it involves large amount, large number of transactions. Large number of transactions and huge amount of expenditures. It involves larger number of transactions and huge amount of expenditures. So if that is the feature of this audit. But now in terms of the benefits or the purpose, you can say to check on the large amount of transactions or expenditures, to check the accuracy of the large amount of transactions that are being done by the government. It is normally done by the Auditor General. It is normally done by the Auditor General. It's normally done by the Auditor General. I want to write the objective, or you can take the screenshot of this.